Hey everyone, so this week's lecture is going to be on uh, liabilities, current liabilities, installment notes, and contingencies. And a big part of that is going to be payroll and calculating payroll expenses. And we are going to describe and illustrate current liabilities, including accounts payable, accruals, notes payable, and current portion of long-term debt, the accounting for payroll liabilities, the accounting for employee fringe benefits, including vacation pay and pensions, on a brief level, of course, and describing the current accounting for installment notes. Think of that like a mortgage where or a car loan where there's a payment every month or every 6 months as opposed to paying it all at the end. Contingent liabilities, including product warranties and also lawsuits, and the reporting of liabilities on the balance sheet and using the quick ratio to analyze a company's ability to pay. When a company or bank extends credit, it's making a loan. The bank is called the creditor, the borrower is called the debtor. Long-term debts or liabilities are due beyond 1 year, and current liabilities will be paid out of current assets and are due within 1 year. The accounts payable or purchases on account are current assets because they're expected to be paid within the current year, and they're usually to purchase merchandise and supplies on account or inventory or services. Accrued liabilities are an obligation to pay current assets in the future. Usually accrued liabilities include something like payroll or accrued legal expenses or accrued tax expenses, and they're recorded as part of adjusting entries, as opposed to the purchase of inventory was recorded as we receive invoices for that inventory or purchase or receive shipment of the inventory. Um, and we can also, similar to companies issuing a notes receivable for accounts receivable that become late, this is the journal entry on the accounts payable side, the company that purchased the inventory. And they're converting their accounts payable into notes payable, which is a 90-day 12% note on account. The initial accounts payable was issued and then they couldn't pay it in time, so they negotiated a 90-day 12% note for $1,000 dated August 1st for their overdue account. And so we debit accounts payable and credit notes payable for the same amount. 90 days. So this is on August 1st. 90 days later, on October 30th, when we pay the note back, our interest expense is calculated for 90 days using a 360-day year. And so we take 90 divided by 360, which is 1/4, times 12%, which times 1,000, and then that's $30 or 3%. Now you can think if this was a full year, it would be 120 because it's 12% interest. And then our cash that we pay, $1,030 is our credit, debit interest expense, debit notes payable. And this is from the perspective of the borrower. The lender would be the opposite. It'd be notes receivable, it'd be interest revenue, and then they'd be receiving cash. And we covered that 2 chapters ago. And this is the perspective from the borrower and the creditor for a different transaction, but similar result. And The initial sale, the borrower purchases inventory on account, so debit inventory, credit accounts payable. The seller debits accounts receivable, credit to sales, debits cost of goods sold, credit to inventory. Then when the notes pass due, transfer the accounts payable to notes payable, notes receivable, or the accounts receivable to notes receivable. And then when the interest is finally paid, it's interest expense for the borrower, interest revenue for the creditor, and we calculate it at 12% for 60 days of the year. And we can also borrow from the bank by issuing a note. Sometimes the issuer of a bond or a notes payable is also referred to as the issuer. The issuer is the debtor. They're the company that owes money. And then the issue is the security that's created, or the notes payable or the bond. That would be the issue. And then the issuer is the company that's borrowing the money. Um, so assume that on September 19th, Iceberg Company borrowed cash from First National Bank, issuing a $4,000 90-day 8% note to the bank. And so they received $4,000 in cash. And so debit cash, credit notes payable. 90 days later, we have to pay $80, which is 8% interest for 90 days out of 360, which is 8% of 1,000 is $80. Divided by 4 is $20, but times 4 for 4,000, that's $80. So we debit our notes payable, debit our interest expense, and credit to cash for the amount of cash that we owe. And in some cases, a discounted note may be issued rather than an interest-bearing note. And this is, does anyone have any questions? Okay. In some cases, a discounted note may be issued rather than an interest-bearing note. And essentially, the amount that's received, there's no official interest that's due. The notes payable face amount is what's due at the end of the note. So for example, in this case, $20,000 would be due at the end. And then the amount of cash that's received is discounted by 8%. And and so the interest rate on the note is called the discount rate. The amount of interest on the note is called the discount, and the debtor or the borrower receives the face amount of the note less the discount, and that's called the proceeds of the note. And the debtor must repay the face amount of the note on the due date. And this is really common in practice, especially even for short-term government notes like treasury bills that are due in 90 days. They're provided at a discount, and there's not actual interest that's paid over time. It's all just paid at the end, and it's all implied. And so to calculate the amount received, we take $20,000 times 9% times 90 days divided by $360, and we get $450 is the interest expense that's going to be due on the note. And so then the proceeds received are $19,550. And assuming that on August 10th, the company issues a $20,000 90-day discounted note to Western National Bank, because this is all going to happen within the same year, because 90 days from August 10th will be October 10th, we can record this as interest expense right away. And so debit to cash for the amount of cash that we receive, debit to interest expense because it is going to be our interest expense in the current year, and then a credit to notes payable for $20,000. That's the face amount. That's what we're going to owe. And then when we actually pay it back, we debit notes payable and credit cash. And, you know, you can think if this was done at the end of the year, we would on like if this was done on December 31st, we'd credit cash. We would debit cash for 19,550 and then debit notes payable for 19,550. The interest expense would be in the following year. Um, However, this example is meant to be very simple, and we're just assuming that it's all within the current year. And so we can expense it like this anyway. And the current portion of long-term debt is the portion of, such as the current portion of installment notes are recorded on the balance sheet as a current liability. And an installment note is a debt that requires the borrower to make an equal periodic payment to the lender for the term of the note. Think of that like as a car loan comes with a monthly payment. It's paid in installments. And a mortgage is paid in installments. The ins and the installments are more than just the interest only portion. It it's paid off over time. There's a principal portion and there is a interest portion, and they're often used to purchase property, plant, and equipment. And they're only the principal portion of installment notes are included in the current portion of long-term debt on the balance sheet. The interest not yet incurred is not yet a liability. So if we think about our long-term debt general ledger account, we have a T account, and if we have a T account for long-term debt and our long-term debt is $1 million, the current portion of long-term debt and then the long-term portion of long-term debt, that added together, that has to be $1 million. And the interest not yet incurred is not yet a liability for that long-term debt. So that's not going to be included in the current portion of long-term debt. Um, Thinking of a mortgage where there's a principal portion and there is a interest portion. And if the mortgage is $1,000 a month, then that's $12,000 a year in payments. And so next year there's $12,000 due in payments, but that's not the current portion. The current portion would only be the principal portion of that. And we would know that from an amortization schedule, which lines out this is all the principal payments, this is all of the interest that's going to be due, and only the principal part would be included for the next 12 months. So we'll go over an example of that in a bit. But first, we're going to do a knowledge check, and I'll open up a poll so you guys can answer this. So please answer this knowledge check 1 in Zoom. Angela Hair Salon issues a $15,000 180-day discounted note to East Bay National Bank. The discount rate is 8% using a 360-day year. What amount of proceeds does Angela's hair salon receive for the note? Okay, so it looks like about 11 out of the 18 have answered. I'll wait for a few more of you guys to answer the question here. Okay, so looks like most of you um, have answered, so I'll just start going through it now. Um, to calculate how much the bank gives for this note, we take $15,000, which is the face value of the note, times 8% interest. And 180 days is half of a 360-day year. So we divide that amount by two. $600 is going to be the amount of interest that's owed on this note. And so we just subtract that from the face value. And so 15,000 minus 600 is 14,400. So the correct answer is D, and that is what most people did get that answer. So great job. And I for C, I can see how it would be um the key word is that it's a discounted note. C would be correct if it was not a discounted note. C would be the amount that the company owed on um if it wasn't a discounted note, if they owed additional interest, that would be the amount that they owe. So you guys did calculate, if you answered C, you did get the interest amount correct, but because this is a discounted note, we have to subtract that to get the amount actually received. Okay. So for exercise 10-1, Bob sold 40,000 annual subscriptions of Bjorn for $60, and they will receive monthly issues beginning in January. And the business had taxable income of 920,000. The federal tax rate is 30%. A quarterly payment will be made on April 12th, 2026. Prepare the current liabilities section of the balance sheet as of March 31st, 2026. So if we think about this, the amount of the annual subscriptions is going to be 40,000 times 60. And so that's 2.4 million. That would be the liability as of December 31st, but we're preparing this as of March 31st. And the key details here, it's an annual subscription and they receive monthly issues. So we can assume that a quarter of this has been used up because we're reporting this as of the first quarter. So if we just multiply by 0.75, we get 1.8 million. That's going to be our magazine unearned revenue as of the first quarter. And then the federal income tax payable, we're starting to make quarterly tax payments. So we have to estimate how much we're going to have to pay every quarter. And so the full year is 920,000 times 30%. Oh, during the first calendar quarter. Okay, that's important to note. So the business had taxable income of 920,000 in the first calendar quarter, and so we're using that amount to estimate the taxes that we owe. So we just multiply by 30%. And so the federal income taxes payable is going to be 276,000, and then the advances on magazines is 1.8 million. These are all liabilities that are going to be used up in the current years, so that's our total current liabilities. And that's, again, for the 9 months of unfulfilled subscriptions because we haven't earned that revenue yet, but we did get the cash for it. Once again, if you guys do have questions, make sure to unmute or put that out in the chat. Entries for note payable. Bennett issues a $600,000 120-day 4% note to Spectrum Industries for merchandise inventory. And this is not a discounted note. This is just a regular issuing a note. And so to record the note, we're going to, and this is for the purchase of merchandise inventory. So we're going to debit inventory, credit notes payable, and then as opposed to settling a overdue account like we did previously, we're upfront. We are purchasing the inventory on this payment plan. And so we're recording it upfront as debit inventory, credit note payable. Then when we pay it at maturity, we pay $600,000 is the face amount of the note plus our interest amount, which is 120 days at 4%. So if we take 120 divided by 360, that's 1/3. And if we take 600,000 times 4% divided by 3, that's $8,000. That's our interest expense. And then our cash is a credit of 608,000. A business issues a 90-day 6% note for 80,000 to a creditor on account. Journalize the entries to record the issuance of the note and the payment at maturity. So this is, again, this is on account, so it's to settle an account. So we reduce our accounts payable, increase our notes payable by 80,000 each, and then we can calculate our interest expense by taking 80,000 times 6% times 90 days divided by 360 days, and we get 1,200 in interest, so 81,200 is our amount owed at the end of the period. And then fixed asset purchases with a note on June 30th. Collins Management Company purchased land for $400,000, including a building for $560,000, paying $360,000 cash and issuing a 5% note for the balance, secured by a mortgage on the property. The terms of the note provide 20 semi-annual payments. That means every 6 months of $30,000 on the principal plus interest accrued from the date of the preceding payment. Journalize the entry to record the transaction on June 30th, the payment of the first installment, and then the payment of the second installment. So we have to record our buildings and our land separately on the balance sheet. So we debit buildings for $560,000 and we debit land for $400,000. We credit cash for $360,000 because that's what we know, and then the balance is secured by a mortgage on the property. So we take the 960,000 minus 360, and we get 600,000. That's our credit to notes payable. So that's the balance of the mortgage. And then notice how they word this. The terms of the note provide for 20 semi-annual payments of $30,000 on the principal plus any interest accrued from the date. So the amount of the payment is not going to be fixed every single semi-annual payment. The interest is fixed at 5%, but we're going to pay $30,000 on the notes payable. That's going to be our debit every 6 months, but the interest is going to be different. So it's very important to watch the details of the wording of the problem, basically. And so then the first installment interest is going to be 600,000 times 5% divided by 2 because it's half the year. And that's $15,000. So our first payment is 45,000 cash, of which 30,000 is principal, 15,000 is interest. And then June 30th, we debit notes payable again for 30,000. And then the second installment interest, we have to subtract the initial principal paid. So it's going to be 570,000 times 5% divided by 2. That's the second half, the second payment's interest. The third payment's interest would be 600,000 minus 60,000 times 5% divided by 2, right? So the interest becomes less the more that we pay off on the loan. If we take the current portion of long-term debt at the December 31st, it's going to be 60,000 because that's the principal payments that are going to be due in the next 6 months is 2 payments of $30,000. That's the principal payments. The interest expense isn't an expense yet. That accrues over time, so we're not going to include that in the current portion of long-term debt, even though our debt payments are going to be around just short of $90,000 in the next year. That's not our current portion of long-term debt because the interest expense hasn't been accrued yet. Could it be disclosed somewhere in the notes to the financial statements? Yes, but that's not going to show up on our balance sheet until the interest is actually due. And then if we're paying it as it's due, it's never going to show up on the balance sheet because we're making these payments as of financial statement dates, really. So if if we had a quarterly statement as of March 31st, we would have an interest payable accrual for the 3 months of an interest between December and June. But that's not a part of this problem. So I just want to really drill that in though. And so PepsiCo reported the following information about its long-term debt in the notes to the financial statements. Total long-term debt of 39,898, the current portion of which is 3,872. And notice it's all in millions, so this is really 3.8 billion. And then long-term debt is 36 billion. So how much was disclosed as a current liability? It would be the 3.8 billion is the current liability, and then the long-term portion of the liability is the 36 billion in the current year. And so um, and I also, companies disclose this in various ways. This is from Xcel Energy's financial statements. They disclose their borrowings as their short-term borrowings. These are line of credits. And they disclose their borrowing limit. Think of that as like a credit limit on a credit card. They can borrow up to that amount, but they uh, they only borrowed, this is the amount outstanding as of year end was 695 out of the 3,550 in millions. So they had a 3.5 billion credit limit. They only borrowed that much. That'd be under the current portion of it. If it is a credit line, that is under the current portion because it can become due at any time if the bank just reduces the credit limit, that could become due. And then they disclose their interest rate. And then for their long-term debt, a lot of companies will actually disclose every single bond that they issue. And so they're disclosing here that they have unsecured senior notes, 250 million due June 1st, 2025. They've got these amounts. They disclose the interest rate. And they've got debt due, all the way up to 2049. And then they have mortgages as well. And they disclose the amounts. And then they also aggregate it here. So the maturities of their long-term debt $1 billion is due in 2025, and then some due 2026, 2027, 2028, and 2029. And if we take a look at the balance sheet, we can see how it's disclosed. And once again, my cheat sheet to find the financial statements is to search auditor cents. It only ever shows up in the audit report. And then we can scroll down to see the financial statements are usually displayed right next to the audit report. And the consolidated balance sheet, we have our current portion of long-term debt as the amount that was due. In the footnotes, they disclosed 1.1 billion that's due in 2025. Since this is as of December 31st, that ties directly to the financial statements here. And then the long-term portion of the long-term debt is somewhere, it would be disclosed somewhere else. Here, it'd be long-term debt is disclosed elsewhere on the financials, so lower. So there's the current section, total current liabilities, and then they have deferred credits and other liabilities. And then they have their long-term debt here, and then they have their total liabilities and equity. So they disclose the current and long-term portion separately. And then oftentimes will disclose the maturities as well. And if Pepsi did not issue additional long-term debt next year, what would the total long-term debt be on December 31st of the upcoming year? It would be 36 billion because we paid up, it was 39 billion this year. We paid off 3.8 billion, and then now it's 36 billion. This is the amount of principal payments that were made. Pay off the principal, there's less due next year. And so if we know that this is what's due, this is the payments that are going to be made this year, we know what the balance is going to be next year. So on to payroll liabilities, and payroll is going to be the bulk of the homework this week. It's going to be calculating the specific payroll amounts. And if you find this section or activity interesting or useful, highly recommend taking my payroll accounting course next semester. It's going to be just 2 credit, all online class on payroll accounting, calculating the same stuff we're going to be doing this chapter, but a whole semester's worth of details. It's only 2 credits, so it shouldn't take up a lot of your time. So I'm looking forward to it. So then take that if you like. And a company's payroll is important for the following reasons. So payroll and payroll taxes significantly impact the net income of most companies. The largest expense for most companies is salaries. Payroll is subject to federal and state regulations. It is not something to mess up. Payroll, tax, Social Security and Medicare tax and sales tax. If that stuff is not paid to the government on time, honestly, really significant immediate penalties happen. And good employee morale requires payroll to be paid timely and accurately. If those payroll checks don't go out, people are going to be mad, really mad that they're not getting paid. I mean, it's people's income is one of the most important things, right? Like to their financial lives is, are they getting paid? And yeah, so people will be mad, and especially like it has to be accurate. The amount of just nuisance from payroll mistakes are insane. So Salary refers to the payment for managerial and administrative services. It's normally expressed in terms of a month or year. And usually it doesn't differ for overtime, depends, but usually people on salary get, well, for my accounting work, uh, we don't get paid extra for overtime. It's just included in the salary, and it's expected that we work overtime. And taking the job, you kind of know that, and you're paid accordingly. But working overtime is not. It doesn't get me any extra money. It's just expected that I do it because that's my job, right? And so that's important just to know for when we're calculating how much we owe. I posted a video this morning on calculating the payroll worksheet. And what some of the salaries are listed as salary, and some of them are listed as wages, which is hourly rate. And it's, it can be increased by overtime. In particular, it's dependent on the amount of hours worked, and overtime is usually applicable. And so the salary or wage might be increased by bonus, commissions, profit sharing, cost of living adjustments, or other items, right? And under the Fair Labor Standards Act, sometimes called the Federal Wage and Hour Law, requires employees to be paid time and a half or 1.5 times the regular rate for all hours in excess of 40 hours per week. And exemptions are provided for executive, administrative, and supervisory positions, including, sorry to say this, accountants. Like some accounting firms do pay overtime, but a lot of them don't. So, and then there's a list of who is eligible and who is not. And John T. McGrath is a salesperson, and the regular rate's $34 an hour. Any hours worked in excess of 40 hours are time and a half. McGrath worked 42 hours this week, so earnings at the regular rate is 1,360, and overtime earnings are 2 hours times 34 times 1.5 is 102. So then the total earnings would be 1,462. I think you guys are all familiar with overtime. I'm sure, like, I've worked overtime jobs where I do get paid overtime. Um, and total earnings of an employee, including any net overtime pay, are called gross pay. And subtracting any one or more deductions to arrive at the net pay. And the net pay is the amount actually paid to the employee on the paycheck. I think we're all familiar with the first paycheck initial shock of, oh yeah, I'm getting paid this amount an hour. I should be getting paid $1,462, and then the amount that actually comes in is less than $1,000. And it's like, okay, what's going on here? And that's because of all the taxes, all the payroll taxes, all the health insurance, everything. It all comes out, and any 401k pension contributions, and then that arrives at the net pay. So key thing to note is that the gross pay, that's the salary expense for the business. And then all these deductions to arrive at the net pay, these are all paid by the employee. This employee, John, earned $1,462 this week. And that's going to be the salary expense for John's wages this week. John is the one paying all these federal, state, local, medical insurance, pension contributions. That's all John's expenses. We're simply collecting it and paying it to the government or the insurance company or the 401k servicer for John. And so that's going to be, we have to divide our payable to all those different line items for John. And so what's going to happen is we're going to have a debit to salary expense and then a credit to wages payable or salaries payable, and then also taxes payable, insurance payable, pension contributions payable. We split the where we pay all this money to, but his actual earnings and the salary expense for us is 1,462. So we're going to go over a bunch of the deductions now, including income taxes. So employers normally withhold a portion of employee earnings from the payment of the employee's federal income tax. And whenever you start a new job, or whenever any employee starts a new job, they are required to fill out a W-4, which includes the marital status, number of dependents, other income from second jobs, as well as extra withholdings or extra deductions that you know you're going to have, and can list that out. And it looks like this. We've all filled one out before, and it lists the name, social security number, the town, which is important for calculating state withholding as well, and then the single, married, filing jointly, head of household, and then employee's signature, but also in the middle here are all the other things, like does they have a second job? Do they have other deductions, like if it's married filing jointly, or if it's single, or if it's head of household, how many children or dependents does the employee have? It's all important in calculating how much needs to be withheld. It's super important for businesses to follow these regulations, because if it's wrong, there are penalties. And so but the business can only fill it out based on the information that the employee gives them. That's why the employee has to fill out this form, sign it, say, I declare this is true and accurate, and that removes the business's liability from it for the most part. Because if the business puts all this information into the payroll software, it says, okay, you need to withhold this amount of federal income tax, this amount of state for this employee. They do, they pay it to the state, everything's good. And I do recommend going over this yourselves, because this is something I go through every year. It's the best amount of money to pay in is exactly what you owe. And so I encourage everybody to fill the W-4 out accurately, and also make sure that it's recorded accurately. I contribute to an HSA account for my own deductions, basically to get to deduct contributions to a health savings account. That's an additional deduction that's not usually included on a W-4, but since I'm contributing around, a significant amount to an HSA, that impacts the amount of taxes I'm going to owe. And in fact, the amount of taxes I'm going to owe is less. So I want to withhold less money. And so I include that in this middle section here, saying that I expect to have, if I'm contributing 4,000 in extra deductions this year. And then I withhold less. And then come tax time, I don't get as big of a refund, but I also had that money up front. I don't feel like giving an interest-free loan to the government. So, it's just a daily reminder to double check your W-4s. Accurate tax planning, so important. Like I'm not trying to owe money, but I'm not trying to get a refund either. The optimal tax planning is no refund, no taxes paid in, and definitely no penalties on taxes come tax day. But that's just a personal rant. So FICA tax is required under the Federal Insurance Contributions Act to withhold a portion of earnings from each employee, and it's two main taxes: Social Security and Medicare, and it's to fund those two programs at the federal level, and the amount is withheld from each employee based on the employee's earnings paid in the calendar year. And the withholding tax rates and maximum earnings subject to tax are often revised by Congress. And note that the actual tax rates for Social Security is 6.2%, and Medicare it's 1.45%. And both the employer and the employee pay this. So for John here, the Social Security is taken from him at which is 87.72, and then 21.93. And the employer also is paying that additionally, and that would be like FICA tax expense or something like that. But that's not recorded as part of this problem. And I also want to say that it's just super important to follow the directions in this course, because in the homework, it specifies in every problem, but it specifies that Social Security is 6% of all earnings, Medicare is 1.5% of all earnings. And that's just to make the calculations easier. It's not necessarily accurate, right? Social Security tax is 6.2%, Medicare is 1.45%. But for this, just to make everything easier on ourselves, the homework is 6% and 1.5%. And then we can calculate, total FICA tax that's coming out of John's paycheck. And then the business is also going to owe that, but that's separate to this problem. And to go really in detail on all these amounts, I suggest taking my course next semester. And additionally, there is a cap, a maximum earnings subject to tax for Social Security, but not for Medicare. Medicare, some CEO could be making $1 million a year. They're still going to have to pay 1.5% Medicare tax on all the earnings. Social Security tax is capped 2025. It's about $176,000. If the employee makes more than $176,000, then this stops getting taken out at that point. And that's also why it's super important to fill out any expected income from other jobs correctly on the W-4 so that the employee is withholding the correct amount for both jobs. If an employee makes $100,000 at both jobs, that's $200,000. That's over the $175,000 cap, 76,000. It's adjusted for inflation, or by Congress as necessary. And if they're making 100K at each job, one of the employers needs to know that, so the withholding is calculated appropriately. Otherwise, it's just going to be taken out or paid in as on tax day, as a refund or as an additional tax owed. So it'll be all reconciled April 15th when John files his taxes, but we are supposed to withhold accurately throughout the year. And employees also might have additional other amounts like retirement savings, charitable contributions, life insurance, union dues, medical insurance. And this all has to be recorded accurately as well. And so for computing the net pay for John, we take the gross earnings minus Social Security tax, Medicare tax, federal income tax, the retirement savings. So John's withholding $20 a paycheck for that. And then the United Fund, a charitable contribution from John out of his paycheck. And then we get total deductions of 392. And then the net pay, that's the amount that is going to be payable to John. And the employers are also subject to payroll taxes. The employer must match the employee's FICA tax contribution. And also FUTA, federal unemployment compensation tax, and state unemployment compensation tax. These are also amounts that are owed by the employer. So they're not taken out of John's paycheck. They're expenses paid by the employer. They vary. These are complicated payroll tax issues. Congress often revises the tax rate and the maximum earnings subject to tax. They're allocated among the state programs rather than paid directly to employees. So if you lose your job, highly recommend you apply for unemployment insurance or unemployment benefits. And The employer tax provides temporary payments to those who've been unemployed. The state and federal programs are closely coordinated. The states distribute the unemployment checks. The state unemployment tax rates are different by every state, different regulations, especially even dependent on industries or the type of business or the specific business. Because the state unemployment insurance, it does penalize companies that lay off employees often. And if employees are routinely being laid off, no fault of their own, claiming unemployment, the business that keeps laying people off, their rates will go up on the state unemployment compensation tax. And so, honestly, I have seen this cause so much drama in small businesses where employers are trying to get employees to quit so that they don't have to pay unemployment, so that their unemployment tax rates don't go up. I mean, it's ridiculous. So I've also seen it not be dramatic at all, where big companies just lay people off and they just eat it. They just know they're going to have to pay more unemployment tax. Um, so, I don't mean to get into that more than necessary, but it's something you should know as a general life knowledge, I think. And so if we're recording this, though, as a business, we just expense that as we owe it. The problem will give us, this is the amount that was owed, or this is the percentage that was owed, and we can calculate it. So the employee pays Social Security tax, Medicare tax, and federal withholding tax. The employer pays Social Security, Medicare, and also the unemployment taxes. As part of this is all in the payroll tax bucket, and this has to be computed under payroll thinking. Federal income tax gets paid by businesses separate to the payroll process because we're computing, the corporate tax based on the profit and loss of the business, not based off of payroll amount. So this is all connected to the payroll process here. And so when we record payroll, we record sales, we have to record sales expenses different to office expenses so we can, if there's reporting considerations on the balance sheet. And this was the following payroll. So they had 20,000 in sales taxes, 20,000 office taxes, sales subject to payroll, salary subject to payroll taxes was 25,000 Social Security, Medicare, and then state and federal unemployment tax, 10,000. Again, it's highly regulatory, and some jobs are subject and some jobs are not subject to the tax rates, so that for simplicity's sake, the problem will provide what is the amount subject to the tax. And so in this example, we have 25,000 and 10,000. And so Social Security tax, 6%, Medicare tax, 1.5%, state unemployment is 5.4%, and then federal unemployment is 0.8%. And then these are the other deductions. So 2,100 in federal tax, $550 in state tax, and then retirement of 1,200, and charity contributions of 250. And so it creates quite the journal entry to record all this amounts. And so we take our sales and office salaries expense. That's the upfront amount. That is this total payroll, that's $25,000 is our expense. And then how we distribute it is different. So the employees are only getting the net pay of $19,025, but that's contributed last, right? So we take all our amounts that are specifically called out, 250 for charity, 1,200 for retirement, 550 for state income tax withholding for the employee, federal withholding of 2,100. Medicare tax payable is $375, and then which is 25,000 times 1.5, and then times 6%, we get 1,500 Social Security tax. Note that we're not including the unemployment taxes because those are paid by the employer, not the employee. Calculating the state unemployment tax is $540 and the federal is $80. And then this is also the employer portion of Social Security tax, that's $1,500. The employer portion of Medicare, that's $375. And so the total payroll taxes paid by the employer is $2,495. And so we have to record that as payroll tax expense and then payable to all the different places that we need to pay um, these taxes. So again, it's complicated. Companies often outsource this process to businesses like ADP or Workday. They calculate all this. They make sure that it gets paid to the correct agencies. And it does provide a lot of saved time, peace of mind that the business is following the regulations. And for paying payroll issue, usually it's an electronic funds transfer or issuing payroll checks. And with EFT, the employee's pay is electronically deposited, and employees receive a payroll statement on how was this net pay computed. And you can look at the paycheck and be like, okay, this is what was withheld for everything and all that. And most companies use a special bank payroll account for payroll. In such cases, it's processed as follows. Total net pay is determined. Company authorizes an EFT to the payroll bank account, and then the EFT or payroll checks are made from the payroll bank account. And that's done for control purposes and also for record-keeping purposes. Sometimes it's just easier if it's separate bank accounts. Sometimes payroll services will facilitate these extra bank accounts. It's a common thing. And they're called what's called zero balance accounts or ZBAs. And really at the end of every day, the balance of this bank account is zero. It's simply a clearing account. So the company authorizes the total net pay, it gets transferred to this account, and then it gets immediately transferred to the employees or the checks or whatever. And then at the end of every day, the reconciled balance of the account is zero because we're not actually storing money in this payroll account. It's just a clearing account for the payroll amount of money. And under, payroll is an area sensitive to internal controls. Hiring and fire common controls for payroll include hiring and firing needs to be authorized or approved in writing. Changes in pay rates are in writing. Employees should be verified that they're coming into work by checking in or swiping their ID card or some sort of way to check in, clock in to work. And a special payroll bank account is should be used or is sometimes used. And a lot of times that's because it's important to, you know, sometimes it's just important to keep track of payments made to employees. That could be kind of a greater fraud risk as if the payment's actually being made to an employee because um, any checks made to an employee, like that's an easy way to get cash from the business is to receive it with a check. And so if an invoice was paid to an employee, that would raise a red flag. But that would be coming out of the regular bank account. So there's a special payroll bank account that's paid special attention to. We're filling out these payroll worksheets. We're filling out all these things. We know the amount of payroll that needs to be paid, and then that's paid, and it's paid to employees, and it's easier to keep track of. It's easier to have control over the cash in that way. I'm gonna put up the second poll of the day. Knowledge check 2. So which of the following taxes is paid by both the employee and the employer in the payroll process? I just put out the poll, so if everyone could please answer. Okay, so it looks like most of you have answered. Um, if we go down the list, A is incorrect because state unemployment tax is only paid by the employer. Federal income tax, as part of the payroll process, is only paid by the employee because corporations pay federal income tax, but they pay that on a business level, on a financial statement level, not on the payroll level. So that's incorrect. Uh, Federal unemployment tax is employers only, and FICA tax is correct. So that is FICA tax is paid by both the employee and the employer. They both owe the 6.2% Social Security and 1.45% for Medicare. Let's see. And which of the following taxes is paid by both the employee and, okay, FICA tax. Perfect. So computing payroll, employee is paid 25 an hour, time and a half for hours over 40. They worked 52 hours in the week, determine the employee's gross pay and net pay. Social Security tax is 6%, Medicare is 1.5%, the federal income tax withheld is 225. So if we just take what's the amount that they earned, that's going to be 40 hours times 25 is $1,000. Then 1.5 times 12 times 25 is 450 plus 1,000. 1,450 is their wages for the week. And then if we take out 7.5% for 6% plus 1.5%, so times 0.075 minus 1400. Then our pay is going to and then we also have to subtract $225. We get the net pay amount of 1,116. And you can see that calculated out here. We have the regular pay, overtime pay calculated. We get our gross pay of 1,450, and then the employee portion of the Social Security and Medicare taxes, and then the federal withholding of $225. So we get total deductions and then our net pay. And then K Mello Company has 3 employees, a consultant, a computer programmer, and an administrator, and the following information is available for each employee. So the consultant works 6,000 for 6,000 a week. It's a salary, so they don't get overtime, and they have federal income tax. It's the following. The computer programmer gets 55 an hour. They're paid 2 times the hourly rate for overtime. It is just because companies don't have to pay overtime doesn't mean that they don't pay overtime. It's possible for office jobs like accountants to make overtime pay, but that's just because the business wants to encourage employees to work overtime and stay working at the company. It really, the overtime laws just say if it's a certain type of specified job, then they have to be paid at least time and a half. But that doesn't mean that the business needs to pay them that much, right? So then they can always pay more. It's quite common. For example, my sister works as a CNA. If she works holidays, she gets double time. That's 2 times hourly rate. So there's a lot of things with payroll that are very much case by case basis. So this computer programmer gets 2 times the hourly rate, 55 an hour. And the admin gets 70 an hour times 1.5 for overtime. The computer programmer worked 46 hours. The admin worked 50 hours. Social Security tax, 6%. Medicare is 1.5%. What's the gross pay and the net pay for these 3 employees? So the regular earnings is 6,000 for the consultant, 2,200 for the programmer, and that's um, again, that's 55 times 40, and then 70 times 40 is 2,800 for the administrator. We take 6 hours times 2 times 55, and we get these 660. And we take 1.5 times 10 hours of overtime for the administrator times 70, and uh we get $1,050. Then we calculate our Social Security tax based off the gross pay, 6% of each, 1.5% for Medicare tax, and then federal income tax withheld, total deductions. And the federal income tax withheld was given to us. They specified on their W-4. They just said, that's the amount we're withholding. And then so we get our total deductions and our net pay. And then the gross pay, that would be the expense, and then the payable amount would be separated between all these different deductions, and then these salaries payable to the employees of the net pay. So some of the following summary data has been omitted for the following period. Determine the amounts omitted. Assume that Social Security tax is 6%, Medicare tax is 1.5%. There is a computer programmer that worked 46 hours and an administrator that worked 50 hours. Okay, so this is actually, it's a lot simpler than you think to calculate what are these amounts supposed to be. So we know that Medicare tax rate is 1.5%. And so if the Medicare tax deduction is 8,100, then we take 8,100 divided by 0.015, and we get 540,000. That's going to be our total earnings. So if we take 540,000 minus 80,000 in overtime pay, 460,000 is the regular rate amount. Union dues will be Social Security tax, Medicare tax, income tax withheld, medical insurance minus the total deductions. We can calculate the remaining deduction. And as far as accounts debited, factory wages, sales salaries, office salaries, we just take the total wage of $540,000 minus 285 minus 120,000, we get 135,000. And this is showing how to calculate each and every one of these in a little bit more detail. And the slides are online. So if you would like to refer back to this, you can. But the net amount paid is 300. So we have our net amount, we have our total deductions, and you can add those together to get the total earnings. Can also multiply by the Medicare tax rate as well. But these are all valid ways to get to the same answer. And the total earnings is 540,000 minus 80,000, we get our regular earnings of 460,000. We take our total deductions, subtract all the known amounts, and then we get our remaining amount for union dues. And then we take total earnings minus the known amounts of factory and office salaries, and then we get the sales salaries as the remaining amount. And this is our journal entry. We take factory wages expense, salaries expense, and then we take our credit to all the payables that are created. And then when the salaries are actually paid, then we debit salaries payable, credit cash. So this particular hot dog stand is a fast food restaurant specializing in hot dogs and hamburgers. This, they have 8 full-time, 12 part-time workers. The average payroll wages is 5,000 for all 20 workers. They hire a they have a PC that prepares the paychecks. They collect the time cards. The program computes the pay, prints a paycheck. The owner authorizes the funds to transfer. For the week of May 12th, the accountant accidentally recorded 100 hours worked instead of 40 hours for one of the full-time employees. Do they have a internal controls in place to catch this error? If so, how will this error be detected? So, could anybody put in the chat how would this error be detected? Because there is a control. If we think about the there's the levels of review to catch this kind of a problem. There's a check signing machine. That means there's someone reviewing the checks, signing the checks, and then the owner or manager authorizes the transfer of funds. That's 2 levels to catch this amount that's more than average. They also know their average in payroll expenses is $5,000. So the owner is authorizing the amount, and then the owner should also be, so the extra 60 hours will cause the payroll to be substantially higher than usual. So that's why it should be caught with this control system. One control improvement for this company, though, is that the accountant is collecting the time card and entering the hours worked, and the same accountant is using the check signing machine to sign the paychecks. And that's a cash control issue because there should be a segregation of duties for the authorization of the time cards and the actual signing of the checks. There should be 2 people in the process between signing the checks and recording the amount that should be on the check. However, it's somewhat mitigated by the owner does have to approve the actual transfer amount. So, yeah, so there's some control issues with this company, but overall they should be catching the issues in place. Many companies provide their employees with fringe benefits in addition to salary and wages earned. It includes vacation, medical, and retirement benefits, and the cost of the employee fringe benefits is recorded as an expense by the employer. Most employers provide employees vacations, sometimes called compensated absences, and the liability pay for employee vacations could be accrued as a liability at the end of each pay period. Many companies wait and record the adjusting entry for accrued vacation at the end of the year. So assuming an employee earns 1 day of vacation for each month worked, the estimated, or 12 days a year, the estimated vacation pay for the year ending December 31st is $325,000. So we record vacation pay expense and vacation pay payable at the end of the year. And then we use that up when employees actually charge time to the vacation code. So for example, if employees are working hourly and we're recording the expense, the wages expense as we go. They work 40 hours this week, we have 40 hours in wages expense. If they work 35, we have 35 in wages expense. If they work 50, then we have wages expense, including that overtime value, when they record 20 hours of wages expense and then they have 20 hours in time off, that time off has to be included like when the employee earned the actual vacation. And so that we would use up this vacation pay payable instead of using up vacation pay expense or wages expense at that time. And vacation pay is a liability. I mean, it's a real liability of a company. That's also the main expense of laying off, of layoffs, is company when employees are laid off, the company has to pay the accrued vacation time for the employees. Um, if they have 2 weeks of paid time off, that they're as their balance. If they get fired, that 2 weeks has to be paid out to the employee, in addition to any severance which may or may not be owed or paid. And this liability is a huge reason why companies are switching to the unlimited paid time off, um, the unlimited paid time off benefits. People aren't actually allowed to take unlimited paid time off. It has to be approved usually by the manager every time. But if they're not accumulating vacation pay, then they're not owed vacation pay. And when they're fired or quit, they're not owed that as a payout, and it's not a liability. And they are recording the vacation pay expense for unlimited paid time off only when the employees are actually taking that time off. And so I mean, it is kind of a cute accounting trick to reduce this payroll liability for the same amount of vacation actually being taken by employees. And if the employees are allowed to accumulate the vacation pay, the estimated vacation pay payable that will not be taken within a year is recorded as a long-term liability. So we do have to estimate how much of this is actually going to be taken in the next year. And sometimes employees might be required to take it all within 1 year, which makes the accounting simpler. That means it's all going to be a current liability. Pensions are a cash payment to a retired employee, and pension rights are accrued by employees as they work based on the employer's pension plan. There's two types of pension plans: defined contribution and defined benefit. And a defined contribution plan it means the company invests a certain amount of money during an employee's working years, and think of that as like a 401k. That's probably the most popular defined contribution plan. And it's similar to like 401A, 403B, 457. Those are all defined contribution plans. And employees contribute some of the money, employers contribute some of the money, and it's invested in stocks, mutual funds, bonds. And the employee contribution is deducted before taxes for the employee, assuming it's a assuming it's a 401k, it'd be after tax contributions if it's a Roth 401k, which is a new thing in the last 2 years. And then the contributions and related earnings are not taxed until withdrawn at retirement. Also, huge advantage to the employer is that the expense is known and it's not dependent on the performance of the investment. So oh my gosh. Okay, thanks for putting that out there in the chat that we're 6 minutes over. I was on a roll. So thank you guys. We'll go over more stuff on payroll in a future class on Thursday. So thanks everyone. That's all for today. Let me know I'll stick around for any questions.